Good morning or good afternoon, everybody, and welcome to today's webinar, Come Alive and Thrive in 2025. We're going to go through a lot of great information today. So as questions come up, please go ahead and use the questions tab to answer them throughout the webinar. And we want this to be as engaging and as informative as possible. So I'm going to go ahead and ask the questions to the speakers as the questions come up. And we're also going to have additional time at the end of the webinar for any questions that we had missed. So with that, I want to turn it over to today's speakers. Take it away, Mark.
Hey, good morning, everybody. Thanks for joining us out here in rainy California. I don't know how everybody else's weather is doing. I see the news isn't doing all that great. Snow everywhere and cold. Janice, where are you?
Mexico City, actually, and it's nice and warm here.
Oh, Janice is joining us from Mexico City. And Nicole, where are you?
I am in Providence, Rhode Island, and it is rainy and snowy.
Okay, so I guess I don't have it so bad. Well, welcome to our webinar. I wanted to, thank everybody for joining us. Rose, hit the next slide for me real quick. I thought this tagline was very, go back one, please. So this tagline came from one of my account executives that started using it in the beginning of January in his presentations, and I just loved it. Come alive and thrive in 2025. We're really going to basically talk about how the year is starting off, what the predictions are from the experts, and then ultimately how LendSure can help you expand your business in 2025 with your lender toolkit. So go ahead. So Janice, why don't you tell us a little bit about who we are to everybody here?
Well, first, we're an amazing non-QM lender, and we were founded in 2015. I am right now in Mexico City, but we're headquartered in San Diego, California, and that's where I live. We also have other centers, Rhode Island, Georgia, Utah, and Missouri. And I think we just opened up another one, didn't we? I can't keep track. We're growing every day. Ohio, there we go. So I knew it. And we can lend in pretty much every single state. You'll see the darker green is where we can lend owner occupied and second homes and investment properties. And then that light green, it's just New York where we can do investment properties as of now. So we are lending in all 50 states, and we're ready to help you close more loans.
So I mentioned that we have some predictions from the experts. This comes from Redfin. So let's just talk about what I call the glass is half full. Okay, so home prices will climb, but it's roughly a 4% national rise 2025 due to limited inventory and strong demand. They're predicting rising prices will keep some buyers renting, but those that are ready to buy will need creative financing solutions. We all know that there's not been much to unlock this locked up mortgage, situation that we have. So rates, they're predicting to stay high. They're not expecting to slide down. Yesterday, our rates just went up, and so did most of my industry. So that's a good understanding of where we are. Rates are likely to average around 6.8% for conforming throughout the year and keep affordability a challenge. High rates will push buyers to explore alternative loans and financing strategies. Consumer debt is at an all-time high, and DTIs across America are higher than they have been in many years. So homes sales will increase, but not by much. Sales to project 2% and 9% year over year, and that's driven by the pent-up demand. The market is literally locked. Brokers, they have an opportunity, but they will help navigate high cost and close more deals with potential buyers. So that's some of the predictions. Rose, why don't you hit me? Some of the other predictions that they're saying will be it's going to be a renter's market. So if we're going to get buyers in the market, we have to kind of facilitate some of that ourselves. Flat rental prices combined with rising wages will improve affordability for renters, but increased rental supply will lead to concessions from landlords, keeping renters in place longer. Brokers can target investors seeking investor loans to capitalize on rental demand. So we can help our investor community, but maybe not the people that are staying in the rentals as tenants. So more home building ahead. You've seen statistically, the home builders have been building homes across the country at a much more rapid rate. This will eventually ease inventory constraints, labor shortages, and high rates remain challenges for builders. And then lastly, you're talking about some of the things that you've seen on the news, the climate risks will impact prices. So you're talking about Florida, you're talking about California. I mean, just, my Southern California district just lost roughly 10,000 homes. So there's a lot of things going on from the climate side that you guys got to understand, and buyers will be increasingly focused on climate safe regions, creating opportunities in Midwest and Northeast markets. You're seeing people move into areas of the United States that they haven't in the past had increases in population. Go ahead. So that's the glass is half empty in my assessment. Let's talk a little bit about the glass is half full. So what does that mean? Well, you're on this call, you're a mortgage broker or banker, and you're vested in your business, and you've survived up until now. I don't know if you know this, but here's the stats on how many loan officers have left the space, about half. So when you look at half of your counterparts exiting mortgage brokering, mortgage lending, you guys have to look at that as a strategic, positive for you. You have, half of the competition that you were working against before on your side. That's an amazing statistic for you, and you should be proud of yourselves working through the battle the last 2 years to be still in this marketplace. So what does that mean? Borrowers with unique financial profiles, self-employed individuals, for example, or investors, they're seeking alternatives to the traditional bank loans, and they're going to be more complicated, and that's where non-QM can come into place to help you with those particular borrower segments. Competition is heating up, and brokers who have diverse programs are winning more deals. So just in my space alone, let's say 10 years ago, there were only 3 or 4 non-QM lenders. There's roughly 40 now. So we have expanded out our own competition in an aggressive way, and your competition has aggressively shrunk. So we're looking to help you guys achieve more market success in 2025 by going after clients that you may not have gone after before. So clients expect fast approvals, more flexible terms, and solutions that fit their goals. That's what your overall buyer profile is expecting. Technology, rates, fast service, having you guys say yes instead of no. It's really what it comes down to. Go ahead, Rose.
Agreed. And I think I'm
going to talk about
oh, sorry, Mark.
One of the most specific it's okay. One of the most specific additives to the market today that helps you as a loan officer unlock the purchase market in every market that's in the United States is what we call Boost. And I'm going to have Nicole address this for you right away. It's probably about 45% of LendSure's daily pipeline. So it's a very popular program and needed in today's locked up market. Go ahead, Nicole.
Yeah, so Boost is definitely one of the great niche products that we do offer here at LendSure. So next slide, Rose, just to give an overview of some of the really niche products that are unique to the non-QM space. We do have the Boost, which is what we term our bridge loans. So it's a little bit different than conventionally how we qualify for our Boost loans. If we can pay off debt with proceeds from a bridge loan to qualify for a purchase. So even if you have a bridge loan that you offer, or if you think you're familiar with a bridge loan, still reach out to your account executive because we really do have a lot more flexibility in our bridge loans than conventionally. Another great one, as Mark had already mentioned, the bank statement program for our self-employment borrower, phenomenal. So there are many times where you get fallout deals or you have a deal that falls out yourself, and it's because the self-employed borrower's tax returns don't qualify. Well, the bank statement loan is a great alternative and another niche product to have in your tool belt. The DSCR loans are a great investment niche product, and this is a no income document investment product loan. Foreign national loans, not everybody will lend with this particular borrower, but we do have quite an aggressive foreign national program. As far as condo tells, so this is a specific type of property where it is a condo that might have some hotel features like a check-in desk, short-term rental requirements, etc. We do have loans for the condo tell property, and it's actually in multiple products that we offer. And then the ground up construction is something that we are starting this year. We have always had a fix and flip, but actual ground up new construction is an incredible niche product that we're offering. And we are hitting the ground running, no pun intended, and already have a lot of interest and a lot of traction in that product specifically. So being able to offer these niche products really put you in the position to kind of be the go-to. They go to you when they know that the tax returns don't work, or they know that we have a loan here, but we're just not sure how to get it done. We would warrant a conversation very easily, and we like to give you solutions that are outside of the box. And really, the more options that you offer, the more opportunities you'll have to grow your business.
All right, well, Mark and Nicole touched upon this, but let's kind of go a little bit deeper into how Boost works. So I love this image. I love visuals. Think about somebody who bought their house several years ago. Their family has grown, they've outgrown their house, but they've also, what has grown is their equity. And this is the perfect solution, is they do not have to have a contingent offer to buy a new house. And when, with the market, what Mark went over is, there's not that much inventory out there. So obviously getting your offer accepted when people are trying to buy, and if there's not that many homes out there, it's competitive. So they can go in with a non-contingent offer, right? So you're going to be able to take the equity out of the departing home and use this as down payment. It's two loans. Just think about it this way. They'll own both homes at the same time, but they only are going to make payments on the purchase loan. And that's something that makes our bridge loan very unique. And they qualify for the purchase loan, but that loan we're doing on the departing residence doesn't count in the DTI for the new purchase. And I think that's one of my favorite things. And if you have not done these type of loans, this is a time you want to call your real estate agents and go, do you have contingent buyers? Has it been hard for them to get, an offer accepted? Or you don't want to wait till the 9th hour, although Mark and I have dealt with our share, I'm sure Nicole has too, of, hey, they're in contract, but their house hasn't sold. Help me with a bridge loan, right? But if we plan ahead, these are the best programs to kind of surprise your real estate agent. Go, well, I have a solution for your borrower. So it's an amazing. I can't recommend it enough. So kind of what I was going over before. These are the benefits. No DTI issues. They're going to qualify for the home that they want to, because we're paying off their existing mortgage, and we're not collecting monthly payments on the departing home. A lot of other bridge loans will have a payment immediately. So imagine having 2 mortgage payments. That could be super scary. Plus also they won't qualify. So these are the 3 main points. And if you walk away today with anything, know that Boost is a great solution, primary, second home, or investment, but you can remove your contingency to buy before you sell. And it's a game changer.
So Janice, I'll add one more item to that. Is a lot of folks are saying, well, why do you guys call it Boost? And the reason so is the term bridge loan, it gets very confusing, because most bridge loans are a standalone transaction on the departing property, and that's not what this program is. This is a full loan solution. We do 2 loans, both the bridge departing and the purchase combined together in one transaction, and it simplifies the process. It helps the loan officer and the real estate agent be able to give security to such a technical transaction. And lastly, it's very competitive in the marketplace, because there's really nothing like it. I call it proprietary to LendSure, but the reality is that there's no other lenders out there that really have something quite like this. So pay attention to that product. It's called Boost.
Yeah, agreed. And just, visually, that this is where our LTVs stand on each type, primary, second home, and the standalone bridge loan. But I know Rose will share these slides with you at the end, so don't feel like you need to memorize this. In all honesty, as an account executive, the best thing you can do is call your AE and go through with them. And I always tell my clients, get me the following information. How much is the departing residence worth? Do they owe anything on it? And how much are they looking to buy? With just those three things, they can help structure and see if there's going to be enough equity in there to tap into it. And you could add in also, hey, you know what? They also have 100 grand that they're willing to put down just in case they don't have enough equity. But anyway, just call your AE. They'll help you structure those scenarios and go through, because once you really understand it, I'm telling you, everybody that has closed a bridge loan with me has loved it.
Janice, I got a question from Becky. She says, this is not a cross-collateralized loan?
Hi, Becky. No, it is not cross-collateralized typically, although I know that maybe larger loan sizes and exceptions, we do cross-collateralize, but it's two loans. So there's a lien on the departure and there's a lien on the purchase. And think of it as a cash out refinance. The terms behind it are just different because it's a 12-month balloon. It's an interest only with no payments. So hopefully that answers your question. If Mark, you want to add anything about when we do cross collateralize, I know we have done it in the past, but not often.
That would be case by case. I know that there's cross default that we would consider, but to add one more element to Boost that probably isn't on the slide is all of the things that people use the cash out for besides the down payment.
True.
What would those be, Janice?
Oh, well, I'm glad you asked. Well, I've even used cash out from a bridge loan to qualify on the purchase because we depleted those assets and added additional income for the borrower. That was I called it the trifecta. It was a second home bridge loan, purchase bridge loan, and then she purchased a new primary. But they could also use cash out to fix up their departing home or the home that they're purchasing, right? Maybe they go, oh, I love this house, but the paint, I want to paint it. Or the talking point for your real estate agents would be the following. You know what? It's a great home, but they've owned it for 35 years and they haven't done much to it in the past 15. Well, once they move out, they can paint it, change flooring, the proverbial lipstick on a pig, so to speak, right? They just fix it up a little bit and it's going to be a lot more appealing to the borrower or to the new buyer, right? And all the stuff is out, all the personal things and items from the other person, they've already moved out. So it's a great selling point because you can say, you know what, instead of slashing your price because it's not the house that people are really like dying to buy, you're going to buy it top dollar because they had a little money cash out to fix it up and then, revamp it, so to speak. So just a few things that come to mind. Paying off debt as well.
Janice.
You're welcome.
Paying off debt, because we're in control of both loans. I wanted to add that in there that we do allow borrowers to qualify by paying down their debt in the closing from the equity of their home. They've paid their closing costs and they've also used it for moving costs. So there's a number of fronts where people have utilized their remainder equity that's available to them besides just the down payment on the purchase. Okay, great. So I want to talk to you a little bit about leveraging technology. I mentioned earlier that, here it is 2025. We're moving into the art of what I call the do-it-yourselfers. So these are loan officers that are very self-sufficient. These people are, placing loans or submitting loans at 11 o'clock at night, and that's not necessarily business hours anymore. So you got to have tools in the marketplace today that loan officers can access, and we take that very seriously. Rose, why don't you show them our technology here?
Sure. Before we move on from bridge loans, real quick, Stacy wants to know what the credit score is for that's needed for the bridge loan.
Typically speaking, 680 or above is what we're looking for.
All right, thank you. There you go, Mark.
Okay, great. So we have a couple of different things that you guys can access from our public site at LendSure.com. One of them is going to be a Boost calculator. So Janice just got done talking to you about structuring a Boost transaction? Well, we actually have the calculator online for you that you don't need credentials to get in. You can log in immediately and start moving over the levers to see if a borrower could qualify on both loans. So you see the departing property on the left, the bridge side, and then the purchase over to the right. And if you're interested in pricing the loan yourself, we have the ability to do so. So you're just going to click on Spark, which is our pricing engine. It's online. It's priced, it's face forward to you, so without credentials required. You can go in and price the bridge or the purchase, or any loan for that matter that we carry in our entire product suite. You should be able to price your own loan. It also has the ability, if you want to, connect with your account executive. So when you're in pricing a loan, your account executive is pinged, and then they ultimately can follow up to see if that if you had any questions or you needed help navigating through a particular loan scenario. So we have that ability as well. Lastly, we got very serious about AI technology, and I know that the industry as a whole is interested in seeing how AI can assist the mortgage process. And we're in the midst of currently building our internal AI assistant for our account executives. And what that's going to do is it's going to speed up the process of information, guideline, rates, and process all through an AI assistant. So as an account executive is verbalizing a loan with you, they may be getting prompted to particular guidelines based on the scenario that you guys are discussing, which is very helpful. We are an exception lender. A lot of loans we do have exceptions. So we have highly trained account executives that are knowledgeable about credit, but having the backdrops of having an AI assistant, putting that information in front of them immediately is very helpful. You should be able to get better service as that continues to mature. We took it so seriously, though, that we decided we're going to build an AI assistant for our loan officer partners. And so at the end of this presentation, Rose is going to be sending out an email to all of you that participated. It'll have a QR code in that email. All you do is hit the QR code with your phone. It'll take you to a landing page. Our partner is named Hellport. Hellport and LendSure have partnered together to create this technology, and we're actually going to foot the bill for loan officers to have this on their own desktop and future mobile application as well. So the beauty of that is the things that a retail loan officer can experience if you were to download this app and work with Hellport. You have immediate access with LendSure. So some of the things that'll pop up will be AI note taking. So I don't know if you have that currently or would like to entertain that, but that's an immediate need for loan officers, where if you're having a conversation with a borrower, that call could then be scribed. It would be, the notes would be taken, and then a summary would be produced that you could easily then forward over to your borrower. It's going to give automated next steps for your borrowers in regards to actionable next steps for the loan process for them. That would be in the summary. It'll have a knowledge base for you as a retail loan officer to know what LendSure will and will not do in regards to a loan. So it'll help you be able to navigate through a non-QM loan conversation while on the phone with a borrower. It's very powerful. It'll have a small size CRM to give you some ability if you're interested in using a CRM tool. And then lastly, it has web recording and transcription throughout all of that process, that if you sign up and you use the tool, that the recordings and the transcriptions all be in place for you. And then lastly, they're working on the mobile application, and that'll be a part of its future release. So this is really just a sign up. We're getting retail loan officers that we partner with interested in the product, and this is a way for them to be able to sign up to get a part of the program for its future release. Okay, so Janice, talk to us about build long-term client relationships with property investors. There you go.
Well, I mean, since it's near Valentine's Day, you have to fall in love with investors because they are long-time relationships that they just keep on giving, right? Investors typically don't stop at one property, right? So building a long-term client relationship with an investor, it just keeps on, like I said, it keeps on giving. So here's some key strategies. You know, you want to really address what challenges your investors have. And with LendSure, there's a lot of ways for us to meet their needs. So all you have to do is understand, you know, hey, what challenges as a property investor have you, come across? And maybe one of them would be, oh, well, I have more than 10 properties now and I can't get conventional financing. Well, guess what? We don't have a cap on the number of properties they already have financed. That would be one kind of thing off the top of my head too, because I'm not reading the slide, but because I've seen that. And, you know, you'd want to create a really positive experience for them. And we try to close on time or sometimes, even early when possible. But you're going to be adding a lot of value to property investors, because that's what really matters to them is, I want a good deal and I want to close fast, and you don't want it to be very hectic. So I really lean on our DSCR programs as well, because it's going to be seamless. If they're used to like having to dump so many documents to qualify for a property, and now you're saying, you know what, the market rents are great. And in all honesty, with my clients, I always quote them both. Hey, do you want to go full doc or DSCR? Sometimes the rate's the same or even better. So, it's seamless. Nicole's like, yes.
Mhm.
But anyway, you want to build the trust that encourages them to come back to you, right? So if they have a good experience, that's typically what's going to happen. And then you offer all the solutions, and I'm sure we're going to go through some of those solutions shortly. But I love the property investor, and if you kind of have the idea of what Mark was talking about at the beginning is, maybe it's not going to be the booming market for a primary purchase for some people, but it will be for investors, because investors continue to grow their portfolios and they tap into these opportunities. So here's a few borrowers that could be opportunities. Fix and flippers. First-time investors, somebody who's already has a primary, maybe you closed a loan with them, you could call them up and say, hey, I have great programs. You want to start getting some passive income or semi-passive income? Mailbox money investors, I'll have to be honest. Mark, do you know what that means? Because I don't. I would love to find out. Mailbox money.
That's an old school term. So investors that want to just own investment properties, and old school, they would walk to their mailbox to pick up their check. So mailbox money. So just strict property investors, no other income.
Oh, okay. Oh, well, that's perfect for our DSCR borrowers. Thanks, Nicole. I guess I need to learn that old school term. I like direct deposit. College investors, I'm assuming that, very young borrowers who are looking. I've had this type of scenario. Someone lives in California, they have some money saved up, but they cannot afford to buy a primary in California, but they can buy out of state for, and we can justify that. Now, our guidelines typically would say you have to own a primary to buy DSCR. Well, you know what? We do make exceptions, and if it makes sense and we know that they're not going to go move there, then we have done those in the past. For national investors, go ahead.
I'm sorry. I was going to say that I think that also means that investors who buy up properties in college towns and rent constantly to the college students off campus. So that there's always going to be a renter base there because the college is there.
Very true. Or also near like army bases and military bases, there's always, people renting there. That probably is better. But honestly, I have run into the other ones, and I'm sure someone's going to get a call. Do you have a first-time buyer who's a college student? Sorry, everybody, but I have actually done those. So anyway, foreign national investors are great. A lot of people want to move their money out of their country and they want to invest in the United States. So if you have family, friends that live out of the country, like me, I have family here in Mexico City. That's why I'm here. Foreign national loans are where it's at. And, people who want to turn their primary into investment property without DTI issues. And, this is one of Mark's favorites, reverse 1031 exchange combined with a bridge loan. That's a niche within a niche. So just a few borrower profiles to get your brain juices flowing.
Yeah, and the DSCR program, to Janice's point, is definitely our most popular investor program, hands down. To her point, if they own 10 properties and they list them all on their tax returns, the amount of documentation that you usually need for income docs, there's a hefty amount. But with this program, if the property itself can sustain itself, we don't need income documents. The DSCR would be at 1. So, right, if the PITIA is 2,500, your rent is 2,500. We do consider it under 1 as well. Again, like Mark said, we are an exception lender, so we will consider that. Loan amounts up to $3 million. Here on the West Coast, we see this in Miami very easily. On the West Coast, you see it in every city and state, especially Los Angeles is one that I had most recently. So the minimum FICO is 620 on the DSCR loans. Naturally, with 620, your LTV might be restricted semi, but we do allow that FICO. We can do the DSCR under 1 with senior management. Another thing is we can qualify off of interest-only payments, and we don't qualify off of the fully amortized payment like conventional. We do truly qualify off of interest-only in the DSCR product. So just quick math, the rental income verification, we do use the lower of gross rents on the form 1007, which is part of your appraisal. In the purchase, we really are relying on that form 1007. In a refinance, we can analyze the market rents, and we typically use the lower of the market rents or a lease. However, if you're seeing that your lease is actually higher than market rent and you can provide 2 months of that rental income, we will go off of the actual lease amount to calculate your DSCR, which again is definitely a niche exception for us.
Mm-hmm.
Nicole, Paolo wants to know what's the max LTV on a purchase?
So that would be depending on the FICO, the loan amount, et cetera. We have gone up 80, 85 on exception. So we definitely have the ability to entertain some higher LTVs with the right profile and property.
And James, don't worry. Yes, I will send you a copy of the slide deck after the webinar. I have your info. So look for an email from me, Rose Waldy, about an hour after the webinar ends. And that's going to have the slide deck, the webinar recording, and a couple of surprises that you'll see when you get the email. Nicole, Kathy wants to know, does the borrower need to have rental experience?
So we do offer the DSCR to our first-time investors. I know Janice touched upon this. We typically look for them to have their primary home owned with ownership history there, but we do offer first-time investor programs with the DSCR and our investors.
Okay. And what's the minimum loan amount for DSCR? Stacy wants to know.
So that's also going to be dependent on where the property is. So, you know, 150,000 would probably be where we want to stay, really closer to under 200,000. But, you know, if you are in certain areas in Arkansas, Pennsylvania, some parts of North Carolina, that just might be the loan amount that's typical for the market. And we absolutely understand that. So that would be another case-by-case scenario. Okay. All right. So another great investor program is a fix and flip. Our fix and flip is a little bit different than conventionally, where you have construction loans, but we do have the same basis on them where we actually analyze the full project. It's not just what your loan is worth now, it's what your property is worth now, plus what you're going to put into it, and then we get the outcome there. So it is an innovative product, and we do have, again, any level of investor experience, to go back to that previous questions. It is designed for investors who are in the business of buying distressed homes, repairing them for resale. So it doesn't necessarily need to be an auction-worthy home. It could be, here in Boston, Massachusetts, we're doing condo conversions. So typically was a 3-unit, and we're actually converting them into 3 separate condominiums on different tax parcels. So we definitely see a lot of unique fix and flip properties, and we love entertaining them as well. A lot of times, to Janice's point, they fix and flip one property and move on to the other. Some of your fix and flip investors can see 2, 3, 4 properties in 1 year. Think of how many returning loans that potentially can be. We use the same common sense underwriting. So again, we really look at that big picture of the actual property itself, the borrower profile, and then the investors do have different exit strategies. So they can actually buy the distressed property, fix it up and sell it, or they can buy the property, fix it up, and rent it. So that would be a fix and hold versus a fix and flip. But we do have that option for both, and we do qualify off of the DSCR.
One thing I like about fix and flippers is that not only, they do multiple properties, but they know each other. They're all part of local investor groups, and so we're talking referrals as well to other fix and flippers on successful deals. So that's something to think about.
And something that's really cool too is that it's a different type of loan process. They don't have to qualify with income. There's no prepayment penalty. There's no EPO. It's a short-term loan, and it really has to do with the after repair value. But I always get those questions. Well, how do they qualify? Well, you don't need income and don't pull credit. You just go on the website and fill out some questions, and then you get a term sheet. But you need to know information about the property.
And working off of, once again, kind of our construction, fix and flippers, we do now offer ground up loan constructions. So what this means, a borrower owns a piece of land and they actually want to build a property. There's no existing structure. They want to build that property on the existing land. We have done those scenarios. We've done the scenarios where they're actually buying the land and the construction for the new property or the structure is also included in that loan. Right now, we're focusing on investment properties only. If you have another scenario, please feel free to reach out to your account executive to see if we could entertain a second home or possibly primary. Typically, again, those loan amounts are going to be around $200,000. Understand that we do realize that certain markets that is sustainable, certain we might have to go a little lower, and up to $3 million. Again, same thing, sometimes a little higher, sometimes a little bit lower. We will do the 1 to 4 units. So if you think about that, you have land and then we're going to put up a 4-unit property. One that comes to mind, we just entertained in Los Angeles, California. There was an existing single family. It has since been demolished, and now our borrower purchased that land and is going to construct 4 units plus an ADU. So think about all of that rental income that's going to come off of that property. So again, going into that, the loan amount on the lot up to 60% of the purchase price, loan amounts versus cost to build. So the total cost to build, we will go up to 85% loan to value. And again, for the experience, we are looking for investor experience, and we do want 3 new build completions. The blah, blah, blah is there because sometimes we have some flexibility, right? They've completed 1 or 2, but they've been in the industry for 50 years, things of that nature. So I think that really goes back to we have common sense underwriting and we are an exception lender.
All right, and I've got a question from Philip. And Luke, I'm going to ask you to please unmute yourself. Luke is our fix and flip and ground up specialist. So Luke, here's your question. Philip wants to know, can an investor do manufactured land/home flip?
Okay. Can you guys hear me?
Yes.
How's it going, guys? My name's Luke KG. I am the fix and flip specialist here. So to your question, we are not able to do manufactured homes at this time. What we are able to do actually is modular homes. So the difference with those being modulars are actually built on a slab. They have their own foundation, where I believe manufactured homes are just brought into the property. There's no real grading of the land that goes on. And they have a lot higher of depreciation values than what a modular home has.
Thank you, Luke. And Heather wants to know, what's the reserve requirement for the ground up program?
We have 6 months of payment reserves that is required. And then they are also required to show that they have enough money to cover their portion of the construction costs. So say we're going to cover 75% or 80% of your construction, you need to show that you have 20% of that in your liquid assets.
All right, awesome. Thank you so much. Mark?
Okay, so Janice mentioned earlier on in the recaps of investors, talked a little bit about the reverse 1031 exchange. So I'm going to kind of keep this high level. If you polled like a group of loan officers, you'll find that most loan officers haven't done a 1031 exchange, and even fewer have done a reverse. So let's just start with that. We have a very competitive program. It is a marketplace today where the reverse 1031 exchange is very handy for an investor because of how competitive the market is. So let's just get to base camp. What is it? It's an investor wanting to buy a rental property before they sell their existing rental property and receive the capital gains, the ability to defer capital gains in that transaction with the IRS tax code. Okay, and so that's why they call it a reverse. They're buying before they sell. Essentially, the reverse exchanges allow the investor to shop at their own pace. And why is that handy? Because in a competitive market, you're going to strike while the iron is hot. And you have to be prepared to move on the property that you're looking for to increase your rent rolls. That's why an investor would ultimately be purchasing a new property. So if they're buying before they sell, then they have to usually have their own capital, and some investors do. And so what they're doing is they're putting their own down payment. They're looking for somebody to finance the reverse purchase. And where our ability comes in to be very competitive is the way that we allow that borrower to hold title with a qualified intermediary. An exchange is going to be created by a qualified intermediary. They're a third party in between both properties, and they are essentially our borrower. And the customer that's actually purchasing, the investor that's purchasing the rental property, is the manager of the LLC instead of the actual borrower of the LLC or the owner. And then when the property
Sorry, guys, Mark is muted, is frozen there for just a second. We're going to give him a minute.
I was wondering if it was just me that couldn't hear him.
a few that allow the ability to hold title this way. So that makes us very competitive just in the reverse manner. So if you have investors that are interested in increasing their cash flow from their real estate portfolio, they're looking to purchase larger properties, this would be a very handy product to get familiar with. In addition, we have a conjunction, an additive to the program, which is a bridge loan. And this is designed for investors that want to utilize the equity in the departing property to purchase the new property before they have sold it. So it's, again, a buy before sell, but they're using the equity in the departing property. So Rose, did you switch a slide for me? Let's see where we are here.
Mark, I'm sorry, your camera's freezing up a bit. Why don't we go ahead and turn off your camera so that the audio has more bandwidth?
Sure. Is that
Thank
better?
you. Yes, that's better. Thank you.
Okay. So I don't know if anything I said conveyed there. Janice, what did you hear?
I know. We got most of it, and I think that the takeaways, it's there.
Okay.
And we're going to be going into.
Okay. So ultimately,
I'm sorry. Go ahead, Rose. No, I was going to say that we're that the parts that were missed in there. We're going to be doing a webinar very soon on this topic, so we're going to be able to go really in detail and in depth about this program. So don't worry, that is coming. Danny, Mark, Danny's got a question. On a reverse exchange with bridge, can the client take a loan on the new property and use the bridge and new loan to get 100% financing?
No, we don't offer 100% financing, but we would leverage the departing property up to a 60 LTV based on guidelines. We've made some exceptions to go higher. And then they pay off the existing mortgage if there is one. Some properties don't have an existing mortgage, but if they do, it's payment free for 6 months. That's the term of the departing bridge loan. Then they take that equity and they use it as the purchase down payment. And then we would do a DSCR purchase on the upleg.
I think maybe Mark's microphone's not working.
And I think my favorite thing about the 1031,
Sorry,
whether
Jess.
we're doing a regular 1031 or a 1031 exchange, is that these are experienced and savvy investors. And a lot of times, if the 1031 has sufficient assets for your down payment and closing costs, those savvy investors not only don't have to give us income documents on the DSCR, but if the 1031 funds cover everything, they don't have to give us assets either. So definitely a great program.
And a way to get clients, like if you're like, well, where do I find these people? 1031 exchange companies. There are lawyers that all they do is 1031 and reverse 1031 exchanges. You start hitting them up and saying, I can do reverse 1031 exchanges. I hope everybody on this call knows it's rare for a lender to be okay closing in a reverse 1031 exchange. So milk that for all you got and say, I know where I can get these done, send me clients. And we can do a bridge loan with it. So you'll thank me later. Call me. No.
As I mentioned, keep an eye out for our next webinar, which is going to be deferring capital gains with reverse 1031 exchange. We're probably going to be doing that in about 3 weeks. So yes, we will be going in depth with that topic. This is a really important topic that's going to really open up new markets for you. So keep an eye out for that registration link. Janice?
Well, the undeserved markets, how to serve them. Next slide, please. Rosal, thank you. Okay, so here goes. This is something that I don't think everybody really takes advantage of, which is our foreign national buyers. I mean, there's so many countries that we allow to be able to work with, and we will close investment properties. We will close in second homes. I've heard a lot of competitors don't touch second homes. So that's another win right there. It's going to make you more competitive. Only need 25% down. And if you see this slide here, it's a $42 billion annual purchase volume during April of 23 through March of 2024. That's huge. And if you haven't tapped into the foreign national borrower market, you really should start thinking about it. And there's so many ways and ideas, to start to kind of get this type of borrower interested. 54,000 foreign national buyers annually. They don't, and there's more, right? There's just so many more than that. I think I could go to the supermarket here in Mexico and say, did you know you can get financing and buy a house in, Florida or San Diego and they would probably go, what? No, I thought you had to pay cash. People, if you educate the foreign national buyer, you will have people, come to you. And I've had borrowers that are the mom and then the cousin, and then it just kind of keeps on going. So it's a market that I still think has, unlimited potential. If you want more guidelines, and I think we can go through that, you can call your AE and ask. But it really is a great, little niche there for you. And we don't ask for much. Sometimes I laugh and say it's easier for the foreign national buyer to buy a second home than it is for an American buyer. We ask for CPA letter, for income. I mean, it really is a wonderful program. So. Oh, and in the last slide, it said, some borrowers pay all cash because they didn't know they could get financing. You could do a cash out refinance. We'll do that. If it's within 90 days of purchase, we can call it a delayed purchase and not have the hit for a cash out refi. So anyway, a little bit more about foreign nationals. They obviously spend billions of dollars on homes in the US. And, in all honesty, many of them are very affluent, buyers. They're wealthy, so qualifying is not going to be difficult for them. And they're looking to invest their money in the United States. So why not help them, achieve that dream? And it really is an untapped opportunity. So I highly suggest joining maybe, I don't know, Facebook groups with foreign national buyers, or I sometimes say ask friends and family, because I think we all know it's at least 1, 2 people who don't live in the United States who, and the word will spread. So.
Janice, Stacy wants to know, do you have a 1 to 4 and a 5 to 8 program, DSCR program? And do you need to be residentially licensed to do foreign national in that state?
A lot of good questions, Stacey. So thank you. Okay, just keeping in mind, foreign national can buy DSCR. They can buy. I would have to check guidelines about 5 to 10 units, but we do have 1 to 4 units for sure on foreign national. And we also do have a 5 to 10 unit. I just would have to check if we were able to lend on foreign national for 5 to 10 units. What was the other question, Rose? The last one?
Do you need to be residentially licensed to do foreign national loans in a state?
Perfect. In most states, there will be some that you will need a license. Off the top of my head, Nevada does require licensing for the loan officer. There are other states like Florida that don't require for business purpose loans. So if you're a loan officer in California and you get a buyer, you know, hey, I want to buy in Florida this condotel, which we'll talk about next. You know, yes, you could do it. It's state by state and has to do with their licensing regulations. So I would just reach out and say, you know, I have one, can you do it? And we'll check for you.
Okay, and Paolo, I think that answers your question. Nicole, do you know for sure whether we can do 5 to 10 on foreign national? I didn't think we could.
I do not believe that's offered right now, but if it's the right scenario for the right borrower, we're definitely willing to entertain it. But in our guidelines, it would be no.
Okay, great. And Janice, Jonathan wants to know, no credit score on foreign national program?
Very good question. We do not require a credit score. We know that they don't have you know, usually there's always, you know, case by case, but usually they're not going to have any U.S. established credit, because a foreign national to us is somebody that lives and works in another country, right? Then you have your hybrid, you know, people who have a work visa and they live in the United States and have a primary and another, you know, and we do those too, but they're just different. They're non-permanent. So for a foreign national, we accept foreign credit reports. So like, since I'm in Mexico, we accept Buró de Crédito Especial. It's free and it's easy for the borrower to pull. And it's actually very easy to read. In other countries, there are other types of credit bureaus, but if they don't have that in that country, they can get alternative trade line letters, and we only ask for 3. So it's relatively easy. I've even used the CPA that confirms income for a self-employed borrower. Like, a lot of people in foreign countries aren't used to holding mortgages, so they do own their home free and clear. So we get that CPA to confirm that the house is free and clear. So. Let's see, did we go over this one already? Okay, there we go. Buyers don't need US credit. I mean, we kind of did. So we do ask for just like a 2-year history. There's so many ways to get creative and try and accommodate what they're able to get to us. So honestly, just reach out to your account executive and they should be able to help you structure. And you could say, look, I have a credit report, but they don't use, you know, they don't use credit cards. Maybe it would be easier for them to get an alternative trade line letters for other sources, like a bank, you know, a bank loan letter. So.
Okay, and then for the credit reports and all the credit letters and other docs, so it has to be translated to English? How does that work?
Yes, we do. Now, every team is probably going to work a little bit differently because I am fluent in Spanish. When I receive documents, I will do a light translation for pre-approval for my team, but we don't make them pay for the translation upfront but I've gotten, you know, letters in Chinese. I don't speak Chinese. So then you would want to get them translated. Now we are, I think, you know, using Google Translate to help understand things at the beginning. But as of right now, our guidelines do require, you know, an official translation for underwriting. Although, you know, Mark was talking about AI and the future. And honestly, I think that little by little, we'll probably be able to use more translation services that aren't as costly and that are more instant. But for now, we do at the end require the third-party translator.
So like Janice had mentioned, we will do second homes as well as an investment. The foreign national DSCR is pretty popular. If you think about it, we just need the credit trade lines. We would need their assets, and then we're closing if the property performs. No tax returns required. Janice mentioned this. It truly is typically a CPA letter that we are getting on the foreign national. We mentioned the credit reference letters. We mentioned that there's a report in Mexico, Canada. Actually, we're usually able to pull something from Equifax. So a lot of brokers use that for our Canadian borrowers. We do have purchase LTVs up to 75% and cash out LTVs up to 65%. Again, a lot of these borrowers thought that their only option was to purchase in cash. Even if you offer a 50% loan to value to recapture that cash down payments, that is a huge benefit and a loan that, again, a lot of borrowers and even realtors don't realize they have an option for financing. Various visa types are accepted, and we also do have a no visa option, especially for our Canadian borrowers and things of that nature. So we would definitely encourage you to reach out to your account executive with some specific scenarios, but please know that we do have multiple options for our foreign national borrowers.
Mark, are you with us? All right.
I'm not sure if you can hear me. Can you hear me okay?
Yes.
Now we can hear you. We were
So
we lost
we're going to get into, good. So it's a terrible storm up here right now, so my apologies. So the last part of this presentation is really going to get into some of the expanded property types that we do. Condos, condo-tels. So Nicole, fill us in with some of these types of properties.
Yeah, so we have been talking about the actual loan products. So in each of these loan products, these are the type of properties or collateral that we will accept. Non-warrantable condo, very, very common in every industry. Non-warrantability can be for a plethora of reasons. We're seeing a lot of homeowners association master insurance deviations. Sometimes there's litigation against an HOA, but it might be a slip and fall and the HOA's insurance is fully covering it. We've made those kinds of deviations and exceptions before. But really what we're looking for is to see if it doesn't meet Fannie and Freddie guidelines. We also have our own non-warrantable guidelines, and we do make deviations and exceptions from them. But for the most part, we are seeing that they have primary, secondary, and investment. We see a lot of non-warrantable investment condos. We truly do. And for the next one. Janice, your condo-tels.
Yes, I said that was coming up soon. Beautiful condo-tels, you know, and Nicole kind of touched upon what a condo-tel is at the beginning, but typically they're buildings that are developed partially as operating hotels. And what makes this so appealing to investors? I mean, think about the rentability, also the cash flow of the property. You know, there's going to be a short-term rental and they're going to be getting more money like a hotel, right? So it really makes it a little bit more appealing. And I've heard this so many times as my loan officers say, I've really been looking for someone who lends on condo hotels. So you could be their go-to. Once you fund one in that building, you're gonna be like, well, here's another one, right? Because they'll reach out to you and say, hey, you're my go-to for this condo hotel. So really, this is a niche product. Even foreign nationals can buy a condo hotel. Hotspots obviously would be like Southern Florida. I've done some in like ski resorts, you know, towns as well. But you know, New York, Boston, I mean, even San Diego has condo hotels on the beach. So I think these are really, really great niche products, and it just keep that in mind as a, hey, condo hotel, LendSure. And then we'll try and make it fit and work. Something to keep in mind in terms of what I've known, and here's some guidelines, of course. Oh, we're switching so quickly. Okay, condo hotel guidelines, you have LTV up to 75, minimum credit score 680. What's really important is ask, how big is it, right? Because if it's really, really tiny and it looks more like a hotel room than it does a condo, it could be an issue, because we do like to see a full kitchen, although I've heard, you know, we've gone away with smaller kitchens, but in reality, you want to kind of get eyes on that. And if it looks just like a hotel room with a mini fridge but nothing else, it's probably not something we can lend on. But I digress. We can move on. I know we're running out of time.
So going from the smaller 1-unit condos over to the 5 to 10 unit properties, we did touch upon this a little bit in our questions earlier, but we do have a 5 to 10 unit DSCR program. So again, usually savvy investors, we are looking for some investment experience for this product specifically. We do loan amounts up to 2 million. I did just get an exception in Boston to go to 2.4 million for the loan amount, and that was at a 70% LTV. We also do cash out on these properties. Once again, a lot of these investors think that 5 to 10 equals commercial or SBA loan or cash or private money. We have better terms than private lenders, and we have far less documentation required from our investors than SBA or commercial lending.
Okay.
All right.
Heather wants to know what if the building has a vacation membership club memberships? Is that allowed for condo hotels?
So when you say vacation memberships, I'm assuming it's timeshare. And we do see a lot of HOAs. Specifically, I saw one in South Florida where there was one HOA, but it had 2 actual condominium buildings. One was fully condotel, non-warrantable condos, and then the second was actually the timeshares. So they were involved in the HOA, but our unit was a bona fide either non-warrantable. So we have entertained the scenario where we do have those involved in the HOA, would be a case-by-case basis.
And I'm seeing a couple of questions here that are very specific with very specific scenarios. And I want to reach out to you, or please reach out to me after the webinar, because I want to make sure that you get as accurate and as complete information as possible. So if it's an actual scenario, let's talk about that offline so that we can get all the details and we get you the right answer.
All right, an accessory dwelling unit. So this is an ADU. I had mentioned earlier, one of the examples we have for our new construction ground up, we are actually building a 4-unit property with an ADU. So that is technically 5 units that you are able to get rental income from that we can contribute to our cash flow, but it is not a 5 to 10. So accessory dwelling units are becoming more and more popular. Sometimes in some areas, Fannie Freddie will not lend on them. We entertain ADUs in all of the states that we lend in. California especially, I'll just highlight, incredibly popular and becoming even more so. So we're going to be seeing a lot of that. But if you see here, ADU, accessory dwelling, I don't want it to be priced as a 2-unit, send that to your account executive. There may be a way to still price that as a single family and move forward. All right, and then the last slide, again, we just said this, it is usually typical for the area, and they are becoming more and more common in just about every area now. Does conform to zoning laws, but again, a lot of zoning laws have different kind of amendments that the 1 to 4 can include an ADU. So we would verify that typically with title and settlement agent. The accessory unit doesn't necessarily have to be attached to the property itself. A lot of times people will get permits to change, say like an ADU at the top of their garage, adding a different separate unit. But sometimes we are seeing that they're actually almost building a tiny home on their property, and the city is approving it as an ADU. So definitely something to consider. And like we mentioned, we will consider the rental unit from that ADU when qualifying.
Janice?
Yes, short-term rental. I mean, I love short-term rentals, and I always loved AirDNA, and now we actually use it. So what is AirDNA? For those of you who are not familiar yet, it is a website that will calculate, they'll take all this analytical data from Airbnb and VRBO, and it'll give you an approximate rent for a short-term rental property. So we allow for that. We have the program for it to 75 LTV. And it's a great option. If long-term rents aren't looking very, good, but it's because you're in a area that short-term rental is where it's at, well, that's the kind of, loan you want to present this. Hey, I have this condo, it's renting short-term already, it's on Airbnb here, we can provide proof of those rents if it's like a refinance. I've even had sellers provide the proof of the Airbnb rents to the buyer, and they show that to us, so we can get it to cash flow. So it's very appealing, and like I said, they make more money when it's a short-term rental. So if I was an investor, I like more money. So this is a great one.
Mark, can you hear us? Janice, why don't you take this one?
Yeah, I'm here. So I'm not
Okay.
sure if you can hear me.
Yes, we can. Go ahead. Okay.
So why partner with LendSure? So what sets us apart is really what we're asking. So we have a highly trained account executive team. They know credit, unlike most account executives in the industry. They know the right questions to ask you with your borrower to build your non-QM loans. I have great confidence in our sales staff to be able to help you create loans. We make common sense underwriting decisions to our guidelines with compensating factors to approve more loans. So being a common sense exception lender, highly knowledgeable account executive, and then ultimately we have some other advantages. We have stacking. And what is stacking? It's another creative way for borrowers to bring less money to the closing table for closing costs and have very competitive pricing options that you can ultimately give your borrower as well. And each loan can be created by your account executive for the most competitive pricing and the lowest closing costs in the industry. So know that your AE is there to help you with that. We encourage communication between brokers and our pre-qual underwriters. Pre-qual is basically a game changer for this industry. We vet your loan up front. We pre-underwrite your loan. So after it's been pre-approved, it should be a Fannie Mae experience from that point on until funding. And most of our competition doesn't operate that way. We do, and that's where we get our glowing reputation as being loan closers in our space. So give us a try.
So as a special treat for you guys, look in the email, the thank you email that I'm going to be sending you in about an hour. Look for that from Rose Waldy. Here is a non-QM marketing resources kit. This has flyers that you can personalize. You can put your contact info, you can put your logo on it, you can put your disclaimers on it. It has the equal housing lender, so that all this great stuff, you can start marketing to your realtors, to your borrowers right away. It's got email templates, it's got slide decks, so and it's got bridge loan, fix and flip, all this great stuff so that you can start generating new business right away. You're also going to get this white paper. This thing it's got like 30 pages in it. It's huge, but it goes into detail on all of these great programs that are on here, and not just program information. It has information about the market, about borrower profiles. It's got all this great stuff. So I encourage you to download it and flip through it. It's a great little reference guide to keep printed on your desk so that you can kind of find all the details about all of these great programs that we offer. With that, I'm going to open it up to Q&A to anybody that has any last minute questions. Here's one that's I was almost afraid that we were going to get. What would somebody be slotted if they are not a permanent resident and not a citizen, but they live in the U.S. and they want to buy an investment property with a DSCR?
That is a hybrid scenario, and we entertain them all the time. So when we say hybrid,
Oh.
you're living in the US, but you still don't have full citizenship. So we may still entertain that in the foreign national program with that loan to value in different terms, understanding that they are either a non-permanent resident alien or possibly a PRA, or we may have completely different options depending on what the citizenship and the status is. But I would definitely say that's something to talk to your account executive. We do entertain it.
All right, awesome. And I've got several questions on this. Yes, you will be getting a copy of the recording. Look for an email from me, Rose Waldy, in about an hour. It's going to have the recording. It's going to have the slide deck. It's going to have the link to the white paper. It's going to have the link to the private label resources. So anything else that you'll need.
Rose?
Yes, sir.
It'll also have the QR code for the AI assistant, and the loan officers can pre-register for that product. So
Absolutely. Yes, it will. All right. Well, let's see. Can you do a fix and flip program session? Yes, as a matter of fact, we do have a fix and flip webinar recorded on our website. Go to our website. Under broker resources, you're going to see mortgage professional webinars, and take a look at that. It has been, it's recorded there. Our next webinar after the 1031 exchange is one that's going to be focused on ground up, so keep an eye on that as well. Christopher, thank you so much for the compliment. I really appreciate it. And you're very welcome. And let's see, with that, I know that we're way over on time. So Mark, any parting words?
no, I just appreciate everybody hanging in there with us, and hopefully a thorough presentation. It adds value to you, and have a great 2025.
Thank you. Janice, parting words?
Yes, I agree. Thank you for being here, and really keep in mind everything we said, because we want you to thrive, and we want to help you do that. So.
All right, Nicole?
Thank you everyone for participating. It was great questions. I think we had some great information here. Hopefully you picked up some good terms to think of, different products, etc., and we help you earn more business in 2025.
With that, thank you so much for joining us today. Bye.
Bye.